Welcome once again to our continuing YouTube video series on taxes and the law. My name is Christopher Neufeld of Neufeld Legal, and in this particular YouTube video we'll be discussing the distinction between short-term capital gains and losses and long-term capital gains and losses in the United States. And when we're talking about this aspect, we're providing you with the general rules. Remember, there's a lot of specificity and a lot of exemptions, alterations that are available, and you should be looking with a professional tax expert specific to the actual transactions and undertakings that you're doing, and doing that in consultation with the Schedule D Form 1065, which gives you a further breakdown of the distinctions on the capital gains and losses. But as for a general rule with respect to short-term capital gains and losses, the general rule is that the holding period for the capital property or capital asset, it might be called, is generally 1 year or less. So if you've held that capital property for any period that's less than or equal to 1 year, typically you're looking at having to report a capital gain or a capital loss on the transaction. Conversely, anything more than 1 year of holding it prior to the transaction will provide you with the basis to claim a capital gain or capital loss on a long-term basis, and the more preferable tax treatment associated with it. Now, what is one of the more principled areas where this rule does not apply and there's a deviation from the rule? And that arises with respect to what is known as applicable partnership interests. And when it comes to applicable partnership interests, the rule has shifted from a 1 year holding period to a 3 year holding period. So if you hold a applicable partnership interest for 3 years or less, you are not going to get the benefits of long-term capital gains or losses. You're going to be subject to short-term capital gains or losses. And conversely, to gain the benefit from a tax standpoint of long-term capital gains or losses, you need to hold that applicable partnership interest for more than 3 years. So what exactly is this interest that we're talking about? It is any interest in a partnership that directly or indirectly is transferred to or is held by the taxpayer in connection with the performance of a substantial service by the taxpayer. This is critical: a substantial service performed by the taxpayer or any related person in any applicable trade or business. So if this is a situation, and you can refer to section 1061 of the code and publication 541 for greater details, you will be subject to an alternate period of holding, 3 years as opposed to 1 year. And as we said, there are other incidences where special treatment, special rules do apply with respect to capital gains. And for purposes of undertaking, we have provided you with the general rules, but the specifics, you really need to reference the code and applicable publications, as well as consulting with professionals as to the specifics of your transaction and your property holdings, because that is the way you're going to get the best benefit out of your transactional dealings, and you won't run amok of the Internal Revenue Service. Yes, you'll probably have to make explanations, but you want to have justifiable reasons for why you're doing certain things, and this allows you to arguably avoid interest and penalties where there is something incorrect. We trust this YouTube video has been of benefit, and we hope you have the best success with your transactions and making the most of tax minimization opportunities which are appropriate as opposed to tax avoidance, as we always say. Once again, my name is Christopher Neufeld of Neufeld Legal, and we thank you for enjoying this video.